morning, good afternoon, and good evening from wherever you're joining us from. Thank you so much for making time to join us in this very informative webinar. My name is Solomon Ilongo, connecting from Nairobi, Kenya, Impact Africa. Let's give a few minutes, a couple of more minutes to allow more people to join, especially those waiting in the lobby as we admit them. And then we'll be good to start. I can see our speakers and our moderator already on board. So let's give about 3 more minutes as you grab a glass of water, then you can start. As we continue letting more people in, kindly type in the chat and tell us where you're connecting from. And you can also tell us which organization you represent, which country, and your practice area. Yes, I can see we have Vincent Omole. Vincent, where are you joining us from? Quite a number of us. If you can type in the chat area and tell us which country or which city you're joining us from, that will be great. Thank you. afternoon. And good evening from where you're joining us from. I can see quite a number of us, and we continue meeting more people in the lobby. You can type in the chat session and tell us where you're connecting from. I can see we have Matthew joining us from Singapore. We have Lovejoy joining us from the UK. Great to meet you. Anna, an analyst at GRI joining from Amsterdam. Thanks for joining. And we have Vincent from Nairobi. We have Mololo from Kenya, and quite a number of us. In the interest of time, allow me to introduce our moderator for the day, Dr. Edward Mungai, who is the lead consultant at Impact Africa Consulting Limited, headquartered here in Kenya. Dr. Mungai, are you there?
Yeah, Solomon, I hope you can hear me well.
Yes, loud and clear.
Super, super. I guess let me put up, a quick presentation up here, and so that then we can get started, and you can let me know when you can see my presentation, Solomon.
Yes, it is there. You can put it in presenter mode. Thank you.
All right. And thank you very much for this opportunity, and welcome, participants. And I guess this, is a good way to start the weekend. Let me put it that way, because after this, I'll definitely be starting my weekend, just to talk about impact and, and what is the new trends, what are the challenges when it comes, to matters, impact. And there is no other, better people to speak to us about this other than Alex and George, who will be introducing themselves in a short while. But I thought that it is important, that I kind of, put together just a small, introduction, first and foremost introducing myself, but also introducing my organization. I know Oxford doesn't necessarily need to be introduced, but for us with small organizations, sometimes it's important, that we say a few words of who we are before then we can be able to get into this conversation. So I'll start by, talking a little bit about Impact Africa. Yes, indeed, this is a boutique firm that is based in Nairobi and have a regional office for Southern Africa, which is based in Lusaka, Zambia, where we do support not entrepreneurs, but organizations to embed sustainability within their business models. Look at this way. We do sustainability advisory services. We do impact assessment and reporting, which is a discussion for today. We also do resource mobilization and capacity building for institutions, and especially international NGOs and also local NGOs who are really looking about impact. Remember, we are Impact Africa. Our job is about creating that impact that we want in the continent of Africa. It's about making our people better, and there's no better way of making our people better other than, through sustainable funding. And this sustainable funding, one, it's creating impact, but also more important is that, it creates some return for those who are putting money. Of course, yes, this is the discussion about that balance between impact that we receive from these transactions, but also more importantly, also in terms of the financial sustainability, because that's also very key. We also support, in HSC, we support in research and innovation. And as, as one of the flagship, we also do training and capacity building. And specifically, I saw there's somebody from GRI. We are, teaching the continent on different and accrediting the continent on different frameworks, and including the GRI framework. We've been, as you can see, this is the map where we have painted green. These are the countries that we have been able to operate in. So when you talk about the continent of Africa, we have some ideas how that looks like. We have an idea what, impact that you are looking for in different places. And I must say it's not one fit all. Again, different countries have different perspectives. I know today we'll be talking a little bit about a case in Zambia, but, let's put that in the lenses of sub-Saharan Africa, because again, there is, differences between these countries, but the hope is that, it can help us, to see, what are the trends and what is going on. We've been trusted by, some of the big companies within the continent, really to say that more and more people are thinking about impacts. So as I said, there's no better time to discuss this than now, because clearly we have seen, may it be private sector, may it be the public sector, may it be about the international NGOs, they are all looking at how can we make our people better and our environment better, by embedding impact into all the transactions that they are doing. We do also have a team, this is the team that is making the dream come true, within the continent. again, working in all the areas that I talked about. We make a joke and we say that, we are made up of Gen Zs. That is what we are, and that's what we can be able, to create that future that we want for the continent. Now, let me take a few minutes just to introduce myself. So probably, Edward Mungai is my name, and I've been in the impact investing space for quite a while. And I thought that, just to give it, a little bit background, back in 2009, which is exactly 15 years ago, I was seated in Copenhagen defending, an investment in southern Tanzania, precisely very near the border of, Malawi. This is exactly a place called, Jombe. And in this transaction, I was very fortunate. I had come, straight from KPMG, where I was doing, transaction services and corporate finance. And here I got the opportunity because of the frustrations, within KPMG. And I say frustration because, we as consultants, we tell our clients what they should do. In most cases, they will do. In other cases, they will not do. And I think it's not about the frustration about KPMG, but it's about frustration, to need to have the money and to be able to do that, which I think is right. And therefore, this journey ended up, taking me to Copenhagen to work for Danish international investment funds, and which then meant that then we had the money. So in that case, the idea was how can we put this money into the best use? And I remember very well now presenting this case, as I said, in southern Tanzania to the investment committee, and imagining I had come from KPMG, where it was about the bottom line. I was putting the IRR, the internal rate of return, and halfway the presentation, I was stopped. And I said, you know what? We are more interested in the amount of tax being paid. We are interested in the number of jobs that this transaction can be able to create. We are also interested in how it will save the country from, forex fluctuations, but also more importantly, how are you going to deal with the infrastructure? How will this improve, and shock on me, because now the conversation is completely changed. It's not about the profit, it's not about the amount of money we can be able to make from the transaction, but it's about the difference that we can be able to make. And I think this is the conversation that we are picking up today, to try and understand, what is the future of that. I actually like, the title that, Alex and George have given their research, which is no data, no deal. Well, of course, they will tell us more a little bit about that, but clearly you can be able to see already 15 years ago, the question that was put in that investment committee meeting was no data, Edward, no deal. And that is about data, about impact investing. Friends, I tell you that the difference that we need to make especially on the continent of Africa, is where we change our perspectives. And we have to change our perspective from the fact of, returns only to impact first, and then for instance, we can talk about financial return. Of course, we must be able to get some level of financial return because it must be sustainable. And where we define sustainability as doing, or rather as that development that meets the needs of the present without really compromising that of the future. And if we are going to achieve that, we must for sure respect environment, we must respect social issues, we must ensure that, economic, development, coexist, with the safeguarding of social issues, safeguarding of the environmental issues. Now, it's my duty now, to invite Alex at this point, and Alex will say a few words about himself, but more importantly, also for him to summarize for us. Well, I think it was George. It was George, sorry, Alex, for that. I think it's George who should be able to give us, a quick presentation, but also Alex, you can give us, a quick overview before then, George can come up with a presentation, to talk about the work that you have done, and then we can be able to have a conversation. But for now, thank you very much, our participants, for attending, and I look forward, to an engaging session where we'll be able to come out, champion for the continent and seeing how we can create more impact, not only in the continent of Africa, also beyond, and how we can be able to make a difference. So Alex, I give the floor to you. Thank you.
Edward, thank you so much for that kind introduction. And thank you also to Impact Capital Africa for inviting George and myself to participate in this webinar. We're very grateful. As Edward said, I am from Oxford University and I'm based in Oxford, but I'm calling you right now from my mobile office. It's actually very mobile. It's a car, so I apologize for any issues in connectivity, but unfortunately I have to get to a funeral this afternoon, hence the situation. But anyway, as I say, it's a pleasure to be speaking in this webinar. I will shortly hand over to George, who will essentially take you through the work that he has actually led over the last few months around this question of data, impact measurement, impact performance, and the transactions that follow. Just to make a few quick headline observations, what we were interested in this research is landscaping the impact investment space, specifically in the context of what are the frameworks for measuring performance and impact that are being used internationally by impact investors on the one hand, and then trying to understand how well that related to evidenced impact from specific projects on the ground. And we took a focus, a developing country focus overall, because that's our mandate. And then within that, we actually did some quite detailed case study work in Zambia, but I'll let George speak more about that. In headline terms, the conclusions that we came to is that in some ways the frameworks for measuring impact that are conventionally used by the impact investment community have evolved over a period of time from a more mainstream background. Impact investment is the fastest growing asset class in alternative investments, as many of you will know. But our observation was that the frameworks that have historically been used and are currently being used are in some ways unfit for purpose. And what we mean by that is that the metrics of impact that they seek to capture as part of the process by which projects are selected or performance measured, those changes is really to socialize that issue, and more importantly, I think, to suggest ways forward to have evidence impact, communicate that, engage with impact investors, and then achieve scale. So we will give George. I'm going to hand to George in a second, and he will give a few slides and some remarks about the work and situate it probably better than I just summarized. But he will do that. But really, what we would like to make this webinar about is an opportunity for everyone on the call to maybe engage with the issues here and think about the opportunities in ways that for ways to do things differently. This is all about, as Edward was saying, this is all about the future and understanding that this is an evolving and dynamic landscape. So I'll end there, Edward, if I may, with those remarks. And if I may, please hand the floor over to George to introduce himself and take us through the presentation. Thank you so much.
Thank you, Alex, for that. And George, you can put up your slides, and also you can say a few words about yourself. Over to you, George.
Wonderful. Thank you very much, Edwards, and Alex, thank you very much for the introduction as well. Could you let me know if you can see the screen okay?
Yes, we are good. We are good, George.
Fantastic. Thank you very much. Well, it's a great honor to be with you today. As mentioned, I'll provide a bit of an overview about the research, getting into a little bit more detail about what we looked at, who we spoke to, and what we found out. This research is available as a paper. It's a kind of open source working paper, so if you would like to read it or to dive into more of the detail yourself, then you should be able to do so if you type in the No Data, No Deal title into Google. just to give a brief introduction about who we are as well. I know Edward very kindly said that Oxford needs no introduction, but specifically Alex, Dr. Money and myself work for an institute within the university called the Smith School of Enterprise and Environment, which is a kind of interdisciplinary research institute where there's lots of people working on sustainable finance, environmental economics, and other similar topics. So I would like to thank the Smith School team for helping to advertise this webinar, and there's lots of research related to this on the website if you'd like to look at that in more detail. And this research was also part of a wider project funded by the UK government, specifically by the Foreign Office, called Climate Compatible Growth. And this is particularly of relevance to Africa because the project undertakes work on the climate and energy transition in 4 African countries. So that's in Zambia, in Kenya, in Ghana, and also newly in Malawi. And this research and kind of technical advice project is running until the end of 2030. So there's lots of interesting research emerging from that project. And if you're kind of based in or working in any of the countries that I mentioned and are interested in getting more involved in the work that we're doing, then I'd love you to get in touch with myself or Alex afterwards, and we can direct you to the people that might be working in the areas that you're interested in. So as mentioned already by Alex, there's been a significant rise in impact investment and also thematic investment in general, where you might consider things like ESG funds or things like green bonds or blue bonds. These are growing instruments of investment, and a lot of them are also targeting emerging markets and developing markets, but also specifically Africa, which is, I guess, novel in some respects, but it's also a great source of hope for those of us who want to see more money flowing to developing countries and countries that need impact capital to grow and to close global inequality gaps, basically. That's kind of the major research context from a meta overall level. And alongside that growth of impact investment, which was quantified just last week, there was a new report released from the Global Impact Investor Network that stated the market's growing at a rate of 14% per year over the past 5 years. There's been an associated increase in demand for proof of impacts from different investors. And that's really what we wanted to look at was why is that coming about? What impact is that having in terms of how they're making decisions? And what does that mean for emerging markets in particular? So we tried to dive into the investor decision-making process, and in answering that question of what are the implications of that for the supply of impact capital, our major finding was that there's a high risk that impact investing could risk increasing or entrenching inequality, specifically because of the way in which impact is being measured at the moment. So that's what I want to explain through the rest of this presentation is why we reached that finding. About 20 different organizations involved in the either impact investing market as investors directly in primary and secondary markets. So with organizations that are involved in supporting entrepreneurs and other organizations involved in that kind of impact ecosystem. Here I'm presenting some results from the latest, which goes to show that nearly every single impact investor considers the measurement of impact to be very important. There's between 2/3 and 80% of investors that have sophisticated approaches for measuring impact. 87% said that they try and undertake some kind of impact performance measurement. But as Alex mentioned, this doesn't necessarily mean that the practices that are being undertaken are working particularly well. So transparency was considered a challenge for the vast majority of investors, nearly 90%. There is limited ability to compare between the impact performance of different investors across the market. And there was also a lot of uncertainty about what to do with the data that was collected. 84% saying they were unsure about how impact measurement results should be integrated into financial decision making. So it's that uncertainty that we wanted to understand more. And I think here it's important to also understand who the different types of impact investors are, because this very much determines their approach. So this was perhaps our first important contextual finding. We try and break down impact investors into primary who would directly invest in capital, either through equity or debt, or through things like IPOs, and the secondary market instead is those who are trading in things like actively managed funds or exchange traded funds or anything that involves effectively purchase of secondary equity or debt. And the reason why we kind of draw that distinction, and if you want a bit more information, you can kind of look in the report at how we define terms. We draw that distinction because we tend to find that the primary market investors are those who are much more concerned with impact measurement and also social and environmental returns, compared to what you hear about a lot, particularly in Europe and America, is secondary impact funds that have used the impact investing label, perhaps more for reasons of marketing or to attract younger retail investors that want to ensure that their money is doing something good. I think that's important to bear in mind for a few reasons. One is because there's a kind of different spectrum of investors from the public to the private when we look at the impact investment market. So it's not like in a standard private market where you just have, largely speaking, private investors involved. We also have governments that are investing in impact funds. We have philanthropies that are private, but also leverage a lot of public capital in what they're doing. So it's a very, I suppose, complicated investor landscape compared to if you're looking at different types of asset classes or more traditional types of asset classes. And actually, if you look at some of those slightly more unusual types of investors, then you can see that they're some of the market leaders. One of those is Ventures, which is a, I suppose, subsidiary company of USAID, so one of the largest donors in the world. And this was established in 2010 by Michael Kramer, who went on to win the Nobel Prize for the establishment of development and innovation ventures. The DIV attempts to target the most impactful and to scale for that they've invested. Comcare, which is a kind of frontline health sector tool, and then there's also an off-grid solar electricity company that has scaled to providing electricity to millions of people. And when DIV is assessing the impact and social returns that come from the companies that they invest in, they use two core metrics. One is a very simple, in some respects, ratio of net benefits to the cost that was put in. But they also consider a kind of social rate of return, which is defined as the rate below which the innovation investment is considered socially beneficial. So they try and set thresholds above which it is seen as beneficial for them to invest in different enterprises. This is getting into the slightly more technical aspects of how impact measurement is done, and I would definitely recommend that if you're keen on kind of understanding this in more detail, that you look into the report, look into kind of under the hood at some of the measurement approaches that are being adopted there. Similarly, we looked at Global Innovation Funds, which is perhaps a bit of an impact measurement market leader that's based in London, that is also a primary market investor. So they looked to provide grants to enterprises based upon this metric of how much it helps those who are living on under $5 a day around the world. And they have a strategy which is interesting because it's very clear that they use impact measurement, not just once grants have been made to assess how well they're performing, but also in the identification and selection of organizations that they want to make grants towards. They offer quite a bespoke approach to this. So data requirements are altered based on how mature the organization is they're investing in. So if they're providing a small grant, they'll only expect a small amount of money, small amount of impact data back in return. For a larger grant, they expect more data in return. They also take a portfolio approach to how uncertainties are dealt with when it comes to impact performance, because when you're projecting performance over a very long time frame, there is inherent uncertainty within that. And they ultimately look towards not just, I suppose, the number of people helped or the benefit per person, but also how likely it is for that venture to sustain and continue to be successful in their case in 10 years' time. So these are just a couple of examples that you might want to dive into if you want to see how some of the market leaders are performing at the moment. Just in the remaining few minutes I've got left, I want to provide an overview of our core findings from the interviews that we undertook. So we had 3 major findings from the investor perspective. One, as mentioned, is the limited consistency in impact measurement approaches, and associated with that, a lot of impact investors expected standardization to become something that we see in the market going forwards. Now, standardization is quite a general term, but when you look beyond it, what that effectively involves is either regulation from multinational governments like the European Union, or kind of superpowers, whether that's the US leading on things like standardization, but it may also be from a more bottom-up sense where industries try and organize amongst themselves towards voluntary standards. It's fair to say that voluntary standards in the impact industry are significantly less developed compared to things like the carbon market or even biodiversity standards nowadays. So in many respects, the impact investment industry is likely to mirror what we have seen in the ESG kind of either climate-related investment or biodiversity-related investment over the past few years. Our second finding was that there is quite broad disagreement on who should define the goals of impact measurement, and that is basically between whether it's the investor or the investee. So we kind of consider that both investors and investees need to work together to decide who is defining impact standards and how much data collection is required for that. And the reason why that's the case is because ultimately, I suppose our core finding is that those who need money most are often those who are least able to undertake data collection for impact measurement, particularly complex data collection. And that's why you can't, as an investor, just put all of the responsibility for data collection on what might be quite a vulnerable investee or an enterprise that's just starting up and is having to devote half of their time and human capital towards collecting data to make their investor happy, especially as impact measurement approaches become more and more complex over time, because there's a demand from the market for integrity, basically. So this is why we defined, I suppose, 5 areas in which an impact standard must kind of deliver for improvement in the market. One is in improving baselining. So this is understanding basically before you've invested your money, what is the baseline conditions, and then setting that as a kind of basement upon which to improve. The second is improvement in things like causal reasoning for how you can attribute things that we see in society from the investment that's been made. That's quite a tricky thing to do, and it's quite a scientific process. So it's quite important to look at the best available science upon that. And then the final few things we looked at was the potential for external auditing from whether it's firms like KPMG that Edward's already mentioned or others. Ideally, it would be those that are already present in the market and that understand the market. And then finally, understanding the capacity of investees and educating them effectively and improving transparency across the board within that. So there's a lot of relevant information within that for policymakers and public policy, I suppose, civil servants. And so we specifically call on them to try and increase the capacity of vulnerable investees to undertake impact measurement, whether that's through educational programs or other ways. And there's definitely a role for donor agencies within that as well in a developing market context. So before I finish, I just want to provide an overview of a case study from Zambia. We have spent the last couple of years, that's Alex and myself, thinking about this very, very interesting fund in Zambia called the Constituency Development Fund. And it's about a $200 million public fund. It constitutes about 4 to 5% of Zambia's annual expenditure from the government side. So it's a lot of money, and the government allocates this across 156 parliamentary constituencies evenly. So each community receives about $1 to $1.5 million, and then the community forms self-organized constituency development fund boards, which decide how the money is allocated to projects within the constituency. So the money tends to be spent on things like schools and health centres or road building, off-grid solar. There's also a fund for supporting enterprises developed by women and young people. And we undertook a report in 2023 entitled Mobilising Investment for Climate Compatible Growth through Zambia's Constituency Development Fund, where we found through investigation of the fund that it was a really, really good option for aggregating these community projects that are decentralized across Zambia, and that there's quite a lot of potential to go towards something that we call blended finance. So that's the mixing of public and private money to create like a kind of overall larger funds that could support the development of climate compatible projects across the country. The one thing that is the barrier there is that there is not at the moment an effective monitoring and evaluation system for the fund, which makes it impossible for an investor to understand what impacts are being generated and where. And as the title of our current report suggests, if you don't have that data, then you can't get the deal. No data, no deal. It's impossible to build a blended finance instrument without good monitoring and evaluation. So we recommended to Zambian kind of civil servants that they work on kind of simple key performance indicators to improve the impact of the fund and raise awareness about it. And that's really some work that's ongoing at the moment. And we are trying to engage as much as possible with the key players in Zambia on this. And there has been a lot of positive interest from the current Zambian government in going down this route of yielding good quality impact data supported by the government machinery to make the case for why international investors should invest in Zambia. So finally, this is the last slide that I'll present today. I just wanted to give an overview, I guess a conclusion of what I've said so far, which is that we found firstly that the increasing use of impact measurement risks entrenching inequalities in access to capital. There's limited industry standards across the market of impact investment. Despite that, there is a need to align the evolving expectations of funders with the capacity of investees to deliver this data. So that's, I suppose, what we want to continue to talk about today. I'd be very interested to hear your views on the report, and thank you very much for listening.
Yeah, thank you so much.
Thank you.
Oh, go on, Solomon, go on.
Yeah, thank you so much, George, and previously Alex. Thank you for the great insights that you've shared. And I wish to welcome our audience to share in their questions, comments, or insights via the chat session, and we'll be looking at them and moderating that. I like the point you talk about increasing local awareness and upskilling on impact measurement. And I think it's at that point that George or Thomas and I met through the Africa Sustainability Matters. So it's part of our way of increasing awareness on impact investment and sustainability across Africa. So once you're on LinkedIn, just be sure to follow Africa Sustainability Matters and Impact Africa Consulting. But in the meantime, as we continue with the Q&A from the moderator, Dr. Edward, kindly sharing your thoughts within the chat session and we'll be able to pick them up. Thank you, Dr. Mungai, back to you.
Thank you, Solomon, for that, and thanks, Alex. Thanks, George, for the for the overview in terms of the report. And I have a couple of questions before then I can open it up, to the audience. And I go back, to where I started. No data, no deal. And you brought in a conversation that probably would like to us to hear more about the inequalities, that are resulting, from the lack of data. We are coming from, and when you speak to many investee companies actually in the continent, and now I'm speaking very specifically to the continent of Africa, they will tell you that if I don't have a fantastic Excel sheet that presents, my business, then rarely will I get funding. It doesn't matter how well you articulate it. It's about, presentation of data, and presentation of what is it that you expect, more even from the financial returns. And I would like, to hear from you, based on this research, what would you advise, investee companies specifically, if they are going to have deals? What is it that they need to put in place so that then they can be able to attract those deals? Remember where I came from, where I said in southern Tanzania, I didn't have the data. And the question was, you don't have data, please go back to the field and get the data. So George, and probably even Alex, what are some of the things that, our investee company can take from this, just also to bridge that gap in terms of funding? Thank you.
Thank you so much for that question. George, I'll have a brief answer, and maybe you'd like to add something to that. I think it's a very clear question. I mean, what I would say is in the first instance, from the perspective of an investee company, I'd highlight from George's presentation the work that he showed about looking at the profile of the specific impact investors. And so one of the points that George was making is that there is not a universal standardized process that these investors are using. And so in a sense, impact investment is no different from a company, from an enterprise perspective or an entrepreneur's perspective. It's no different from any other sort of funding, in the sense that you need to know your investor. So one of the things that I think the research helps to highlight is in identifying who it is that you think are appropriate impact investors for what it is that you seek their support, is to spend the time and attention on understanding what are the metrics and measures of impact that they identify and seek in prospective investments. In a sense, what the work in this very specific question, what the work has highlighted is the idea of a generalized, PowerPoint deck and a standard set of numbers may not be the most effective way to try to engage with these sorts of investors. So it's the specificity within this impact investment sector, which is much more differentiated between investors probably than a conventional primary or secondary investment firm. I think that is a good starting point. And then of course making sure that the data that you are able to provide aligns with the framework, format, and expectations that they're setting out. Of course, I mean, one of the points that we're trying to make in our work is sometimes what impact investors are asking for may not be the most appropriate information from an impact perspective, given who the investees might be. And so it's also to try to, in engaging with impact investors, for the entrepreneur or the venture firm to socialize other components of impact that they believe is important to what they're doing, so that at least the investor can be across that and have a better understanding of how impact is actually realized in that venture, that may expand beyond what their own frameworks cover. So so those are some direct thoughts, yeah, Edward, just in regard to that question. But maybe I'll hand to George in case he wants to add on that. Thank you.
Yeah, I think I'd be very interested to hear your answer to this question, Edward, as well. Once I've said a few words, but I think from the experience of particularly, a lot of the research, as you can probably tell, was undertaken in Zambia, which, as we mentioned before, is just one country, but in many respects tells a story of a typical sub-Saharan African kind of low to nearly middle income country, where there's a lot of people that have, in theory, have access to the resources they need to make a strong business case to an investor. People have internet access, and they have, access to the same resources that anyone who has access to the internet has. But it's a case of being able to apply those in a way that attracts whatever that specific investor may be. And I think that seems to be a relatively prevalent skills gap in Zambia in some respects, in that whilst people in theory know what they should be saying when they're engaging an investor, for some reason it is difficult to practically build up a business plan that meets the needs of the people they're talking to. And that's why people talk about this bankability gap, where an investor will say, we have this money we want to invest, but there's not enough bankable projects. And on the other hand, the investee company saying, we have a great project, but we really struggle to find the money that we need. So I have less experience of how to address that than I'm sure a lot of other people on this call. But I'd be quite interested, Edward, what your thoughts are from either the Kenyan experience or just all the other work you've done across the continent.
Yeah, sure. And I think I can give a few thoughts in regards to it. And yes, what you're saying, George, and what Alex is saying, is 100% right in terms of what needs to be done just to bridge that gap. But also from the impact investor side, I think we need to see more accommodation, for them, and really to appreciate that, sometimes the investee companies might not necessarily understand their language. Recently, I came across, a new I don't know whether it's a new concept in the US, where they're talking a lot about search funds. Now, I think what that mentality of searching, where you have the impact investors, being the one who are almost on the ground, not necessarily physically, but trying to establish a couple of pipeline company that they would be interested in, and if it shows some signs of appetite, then they can be able to come in and support the investee companies actually to package the impact. Because as Alex, you rightly say that it's not one fit all kind of a situation. It depends on a case by case basis, and it can only be because they know exactly what they are looking for, from that perspective, and they can be able to walk the journey. If it's a microfinance bank, they can be able to walk the journey with that microfinance bank, trying to appreciate and trying to see how they can package the impact. Because one thing for sure is that there is a lot of impact, only that impact is not accounted for, only that impact is not clearly defined from an investee company perspective. But then if the investors can be the one, obviously through this search process, can be able to guide the investor to appreciate. And of course, things like capacity building, because after you have invested, also you need to keep on teaching the people in the investee company on how to account for the impact. You also have to, to sensitize them, this is the impact that you're looking for, and therefore they become very clear. Because also the management, and I like, the fact that you're using impact measurement and management, not just impact measurement. That management piece is very important and is a long-term journey. So again, if they can be able to work and probably sometimes even have technical assistance money, that will be put for the purposes of supporting, that impact that you want in the transactions. Those would be my 2 cents in regards to that. And I'm really flipping it to the side of the investor themselves, helping our people, the investee companies to appreciate the kind of impact that can be there. Now, to my second question, is more about, again, probably I have an answer, but for the sake of the audience, I would much be interested to know how much, of value are the impacting. I mean, look at the decision making of the impact investors. How much value are they putting to this question about impact? How is impact driving decision making at the impact investing funds? And I don't know whether this is something that you explored within the study, and how you see that panning out, and how important is it?
George, you'll permit me just to quickly go first again. I'd like, if I may, Edward, just before taking that second question, just picking up on two really important strands on your excellent remarks just before you asked that question. And that was really in relation to this idea of accommodation and this idea of searching. So, I absolutely concur with what you said and how you said it. But I go even further than this, right? I'm in addition to what I do as an academic, I'm an entrepreneur and I used to work as an investor. So I have a perspective on all these dimensions. I really believe that the narrative of what impact investing is just needs to be thought about. We are not, if you're an investee company, the investor is not doing you a favor. They're not, it's not a charity. They are getting involved because there is a transaction to be concluded. And in a transaction, there are two parties. And, we investee companies should not be in a situation where, the emotion is gratitude or something like that for this engagement. The issue is, we know in the context of the continent of Africa, we know today that we are 1 billion, circa 1 billion people. We know for a demographic fact we will be 2 billion people by 2050. This latent growth is a self-evident reality. We know that, with Starlink and submarine cables and whatnot, our connectivity and our ability. Sorry, I'm from Zambia. Why I keep reverting to we? I'm sorry, but why our connectivity and our ability to be part of the digital economy is only going to get stronger. We know that with our endowment in terms of energy and renewable energy, our capacity to be a net generator of energy will be, unparalleled in the world. We have all these different dividends going on in Africa. We have this extraordinary productivity potential through the demographic change, our ability to lead technologically into communication, and energy, which is going to be a key issue that identifies us in this next century. Africa again has comparative advantage. So I think we should also, in addition to those very correct points about the specifics in your Excel sheet or what have you in terms of the presentation, we should be landscaping this opportunity as effectively as we can, because this is a transactional thing. We have people, entrepreneurs, ventures, ideas being generated in this. The challenge our continent has is because of historical precedent, we lack the embedded base of large pools of domestic savings, which are what are typically recycled in developed countries to finance things. Our history doesn't give us that for reasons we all understand very well from history. But what we really want to do is make this narrative of the transaction and the bi-directional opportunity fundamental to how we engage and approach on impact investment. And then I think that kind of links quite nicely to your second question, which is, so what is the work that investors need to do and should do to engage in this? What is the value over and beyond bringing money, which is obviously necessary, to this party? And that is where I think, and what we I think George will say more, but what we have identified in landscaping, there are certain approaches that certain types of impact investors are using that I think are self-evidently much more value accretive, not just to them and to their LPs and so forth, but also ultimately to the companies, communities, societies in which these ventures are thriving. So I think your remarks were well made. I think your question is really important. And really my sort of parting comment on this question is this narrative change to contextualize opportunity in the reality of today. This is not the reality of 15, 20 years ago. This is the reality where critical minerals, one of our natural endowments, is going to be in strong demand, where all the other things that I've mentioned are going to be key to the societal transition. We are an investment opportunity in Africa, and empowering more people from Africa, more entrepreneurs and founders and so forth, to understand and grasp and communicate this narrative, I think is fundamental to the evolution of impact investment. Anyway, I submit there, and over to you, George. Thank you.
Yeah, thanks a lot, Alex. Completely agree. And I think, I mean, on the point, the question you had, Edward, about how much are investors using this data in their investment decision making on the kind of impacts in society side. Again, it depends on depends on who the investor is. There's a few people we spoke to who said not really at all at the moment, and then there's other people who said 100%. This is the kind of 50-50 balance of, on the one hand, financial return needs to be an IRR above the thresholds, and then the social return also needs to do that. I think a good example of this that I was looking at yesterday was the USAID, who, as mentioned before, invest or provide the money to Development Innovation Ventures, the company we looked at. They've set themselves a new benchmark since 2018, which is all of their development spending needs to perform better than what a cash transfer would. So basically, if they're spending money on a program or investing in an enterprise, that needs to be better than just giving cash to individuals within a population in terms of the social returns that are generated. And they released a position paper yesterday that people might be interested in looking at, about how they're finding the process of kind of meeting that obligation that they've set themselves. And there are some details in there that I think have been kind of flagged in the chat by Sarah in a very interesting way, which is that it's not easy to look at short-term financial results are significantly easier to calculate than an uncertain social return pathway, particularly that if you're putting money into a school, for example, and at 0.0, then you may only get the kind of benefits of the educational return in 5 to 10 years afterwards. Like we all kind of know that stuff. But I think it's also revealing of where the pressure in the market's coming from, right? It's like there's a political element to this, particularly with donors like USAID. That's obvious, because people are demanding that what is, I guess, like taxpayer money from Western countries is spent well, but in a much more meaningful sense in the impact investment private market. Retail investors are demanding basically like strong impact returns, and you can't get a strong social return if that social return is not considered in the investment process to begin with. So there is quite a significant shift towards this, I think, being seen as an afterthought to instead being seen as something that informs the investment decision-making approach. Although people are more or less willing to speak about that in private, and I think in general in public, investors are not particularly good at speaking about how that process happens, which is a kind of transparency related issue that probably does need to be dealt with as well.
All right, thanks for that. I can see we have a couple of questions on the chat. And I think the first one, probably that I let you, George, to comment on. How can we better align short-term financial data with long-term impact goals? I don't know what's your take in regards to that question.
Yeah, I mean, I can provide some initial thoughts. There's a few ways of doing this. I guess you can either you can try and financialize your impact goals so that you have a direct comparison between financial data in the short term. I guess a good example of this is from the water sector, which is the sector that Alex and I work on as well, where the kind of price of, say, like a water and sanitation project or venture does not necessarily, like, the price of water is not a good proxy for the I guess social return that's generated through the use of water. That's one of the things that has been kind of recognized in environmental economics for a very long time, as there's a lot of positive societal externalities that are not priced in to markets, and that goes for almost any kind of social, like any spend that generates social goods. Quite often, if a government is undertaking like a cost-benefit analysis, or a private company is undertaking a cost-benefit analysis, they have a very, very strong idea of the liability on the short-term financial side, but are not very good at quantifying the benefits also in short-term kind of financial ways. So that's where it gets a bit more technical. That's kind of one way in which you can have better alignment. I think that's probably the best thing I have to say to that. It's all, I guess, comes down to a bit of a mathematical approach. But I'm not sure, Alex, if you have thoughts on that as well.
Yeah, thanks, George. I mean, maybe let me just offer a slightly different alternative way of also thinking about this. So this question of short-term financial data and long-term impact or long-term outcome, So just looking at it from, so I run a for-purpose business, right? I run a for-purpose company, and as a for-purpose company, we set out our objectives, our societal and other things. That's what we're driving towards in the long term. Now, short-term financial data is kind of a marker of progress, right? It's a marker, it's an indicator of progress in terms of how you're proceeding on the journey. And so what's quite important to me is, depending on who the audience is that I need to speak to about it, it's using that short-term financial data where, and it may not be purely financial, it may be other types of short-term metrics, but using it both to evidence execution, in whatever it is that we're doing, but also to connect that narrative between, long-term impact is about the collection of the short term. You don't suddenly get to long-term impact. You get there day to day, week to week, and investors and others, broadly speaking, who are sophisticated, understand this. So actually, I think short-term data, used appropriately, contextualized, and communicated with the understanding of why it's being presented in the way it is an incredibly powerful way to bridge this gap between what happens today in day-to-day performance and the kind of impact objectives that you're seeking to communicate. So that would be my, it's a different answer. I mean, there are different ways of thinking about this question, but that's one that I'd propose. Thanks.
Yeah, and I also have some little views in terms of that, and I think it's a question about matching, because I saw Sarah, I think is her name, also had put a couple of more questions, and one was how then do you manage the investor based on that short term versus the long term information requirement, and I think it's a question of matching. It's a question of knowing who is your investor, because in most cases you'll find that most of these investing companies in the short term probably they will be running out of cash. They will also probably not be making a financial return, but it's about how patient into the long term, how patient is your investor, and how are they willing to accommodate you, again the word accommodation, to the point that you can be able to unlock that long-term value. And just to give an example here, a couple of years, maybe 2-3 years ago, I was serving in an investment committee, and we got presented with about 300, it's a funnel, 300 possible pipeline companies. And believe me, out of all those 300, probably, it ended up that only 2 are investable. Well, you could ask the question, is that the correct situation? But I can tell you the problem was that, the members of the investment committee, it was a mismatch, even at that level. People who don't understand impact investing, they are, private equity people, and their job is to kill. That's the language, kill. kill, they move. I mean, this doesn't make sense, whereas if you had people who understands, impact investing, probably we would have seen maybe 50, qualifying to the next stage as opposed to the 2. And I think that's also the same, that is happening with investors. It's just a matter of matching who is the right investor for you. If you are looking for impact investors, are they patient enough to be able to accommodate you? Of course, they must be able to see the value to the end. And that, raises another question, and it's about, we are talking about impact. And the question is, during the work that you are doing, did you come across frameworks, because again, that's also another challenge. What is this impact and how is it measured? Are there, frameworks? And I'm thinking about, for instance, we talk about SDGs, we talk about 169 targets. Would those 169 target be converted again to become, kind of the KPIs that you are looking for when it comes to impact? And I'm just curious to understand whether there was frameworks, and are those frameworks, relevant for different markets? For sure, they can be standardized. And I saw somebody talking about biodiversity. Obviously, there will be elements of, standards on biodiversity. There will be others on climate change. But just wanted to hear, what's the level of understanding from the investors and also from investee companies of these frameworks that they can be able to use to measure impact.
Yeah, it's a good question, and there are a number of standards that, or I guess frameworks that exist at the moment. So perhaps the most famous in the market is the from the Global Impact Investor Network, and there's a framework called IRIS Plus, which gives quite a it gives a detailed set of potential metrics that an organization could use, and it's broken down into sectors and it's broken down into types of impact. And it's essentially a toolkit for those who are starting thinking about impact measurement. What it is not is a framework that recommends best options or approaches for a specific circumstance. And I think what I'm trying to say there is that it's not something that could easily be adopted into like a regulation, for example. It's not like if everyone started using the IRIS Plus framework, then the whole market would immediately be improved and all these issues would be solved. Not that regulations necessarily do that either, but it's effectively more a set of definitions. And so if you find yourself in a situation which is quite common in the market, I guess one example I would give is that you're an investor that talks about things like livelihoods improved or jobs created. Those are things that are quite hard to define, and often those definitions are not kind of provided. So that's a situation in which an investor might look at the IRIS Plus definition of what it means to create a job. They might say like it needs to be at a certain salary rate for a certain portion of time, and then you can count it and you have data that proves that. So no, this is probably one of the biggest barriers, I suppose, is that these high quality frameworks that people can coalesce around there's not kind of an industry de facto standard at the moment.
All right, and I can see another question here coming from Matthew, and Matthew, very much related to short-term, long-term, goals. But now he's asking about, did we find, pricing of externalities, into the conversations? And, I think he's asking the question, does pricing externalities support linking the short-term returns, to the long-term return?
Yeah, go ahead, Alex.
Thank you. And I'm sorry, I can't see it correctly. I'll be back here to thinking about this Constituency Development Fund case study, which George was talking about, and this is the issue really, where a lot of the returns that are generated, the societal return or externality returns, for example, by improving education outcomes or improving health outcomes, are not in the case of a public investor, like in this case the government of Zambia. There's a reasonable case to think that the externality benefit that's being generated from that will ultimately be captured by the funder, right? Through improving productivity over a period of time, which is then captured the tax base and all of those things. And so this issue of externality benefits, privatize, these are often socialized rather than being easily accrued to the funder, is one of the reasons why we found the CDF mechanism really interesting as a potential vehicle for blended funding, blended finance, because you could identify ways in which some of these types of returns could still be captured within a long-term investment framework, while still enabling other types of investors who wouldn't ordinarily directly capture that return to kind of participate in that through their involvement. So I think the reality is in general terms, impact-related externalities are fundamentally difficult to A, quantify, B, identify in terms of the phasing and the timing, and then C, to kind of capture in terms of a financial return that accrues to a specific investment. In a sense, that's the definition of an externality. But I mean, the work that we've been doing, particularly thinking about where one of the investors or one of the funders is a sovereign entity or a public agency, then actually there are frameworks that we can think about that capture this long-term externality within that framework of investment. Thanks.
Yeah, let me bring in another perspective to this conversation, and I'm borrowing from the discussion about sustainability. Of recent past, we have started hearing of the words greenwashing, greenwishing, greenhashing. All those are narratives that you are seeing, especially from an environmental perspective. And I'm curious, when it comes to impact investing, are we seeing possibilities of impact washing now that a lot of funders are investors are looking for impact? Are we seeing, for instance, investee companies, taking that route of impact washing, and how does that look like? George.
Yes, absolutely. And I guess that's maybe something I didn't talk about so much in the presentation, but that's kind of one of the other key contexts, I suppose, is that there's been, and kind of the introduction to our report talks about this in a bit more detail, but there have been a number of relatively high profile kind of studies recently that have called out impact investors, particularly in Europe and America, for overstating the impacts that they're generating. And quite often things, particularly when it comes to those metrics I mentioned around jobs created or livelihood supported, or particularly in carbon, it often comes down to things like trees planted. You might go to a typical impact investor website and they'll have a figure saying, through our fund we have sustained this number of livelihoods, this million number of people, we've planted this million number of trees, and when you dig into it you kind of realize it's actually very much like a kind of marketing impact washing approach, right? So yeah, that's definitely the key context here, is that I guess the key tension is you need to balance addressing impact washing by having high quality impact data and making sure that collecting that data is not stopping vulnerable investees from being able to access the money that they need. So yeah, that's a pretty crucial thing to think about.
Yeah, sure. And as I said, on one end, people are trying to put a case of impact, and therefore, chances of impact washing will definitely be there. And I guess that's why probably we need these frameworks to then, can define to some extent, in a very objective way, what is proper impact, and what is being washed, as a matter of fact. I think I really like this story about the CDF. And why do I like it? Because this, apparently is a model that is being used across Africa. In Kenya, for instance, I can tell you we are really struggling in the sense that, first and foremost, there is even issues about accountability. There is issues about ownership, who owns, once the money is put onto the community who wants that money. And I I like the fact that you see blended finance becoming, part and parcel of that. But I feel like, there are a lot of work that need to be done for us to be able to convince investors that they can be able actually to put money into some of these projects. And again, I don't know whether you have some experiences. What would that look like? I saw at the end of your presentation talking about policy, and I don't know whether that could be, the solution to that. Put it differently, what will make investors invest in CDF projects in Zambia?
So thank you for that. So that excellent question. It's what I spend a lot of my time thinking about and working on at Oxford, and it's it's an important question. I think Zambia in many ways, we look at the model in Kenya, and I think Ghana has something as well, and it just happens that Zambia has some certain attributes about the distribution of density of population, the decentralized structure of governance, and so on, that has made the modalities of the CDF quite effective, and it has extremely high bipartisan support because irrespective of which party the MP of that constituency is, they receive the same amount of money, and so it's one of these kind of approaches that has led to greater political consensus than you might imagine. But to your point, so if you'll give me a minute, I will just try to explain how we're thinking about this, and this actually links back to the comment before about externalities and sort of societal returns that you need to think about. So our own views. I've spent many years working in blended finance, and particularly in water and other sectors. And it's a challenging thing because blended finance is not free money.
So sorry, Alex, for stopping you. I just realized that it might take, it might be worthwhile to spend 30 seconds saying what is blended finance. So that probably we can all be together.
Yes, thank you very much. Yes, so I mean, in very simple terms, blended finance is the idea that to achieve a development-related outcome, it may be that the risk associated with an investment is too high, or the return associated with that investment is too low by itself for the private sector to fund it. But the idea of blended finance is that by incorporating concessional funding, so either grants or lower cost capital or some other thing, you're able to bring down the risk associated with a project and or raise the return associated with that project that delivers a development, like typically an SDG development outcome. So the idea of blended finance is a mechanism to effectively reduce risk or enhance return through the use of concessional capital or grants and so forth. And it's become a big thing since basically since Paris 2015, when certain targets were set for SDG aligned growth in blended finance and so forth. It is still although it gets a lot of publicity, it is still a very small part of the overall funding landscape. It should be bigger, particularly in adaptation finance for lots of reasons. But I think what people sometimes forget is that blended finance involves a return component, because if you're involving commercial or private sector finance, they want to get something for it. So understanding when it's used and how it's used is really important. We were interested in it because we thought that a lot of projects, taking Zambia, for example, were not today a good target for blended finance, in the sense that there was a huge amount of societal, environmental, and economic return, including externality return, that investing in schools, hospitals, improving gender equality, all these things that George was talking about. These are specified categories for the CDF. Huge amount of return to society that could be generated, but it's not obvious where the financial return is in the short term. Long term, of course, as the productivity translates into economic output, it's easier to see. So one of the things that we're working through at the moment, and Edward, you might be interested in this, is this idea of, rather than blended finance, think about blended funding. So actually, you still have a sovereign entity who can capture the externality benefit over the long term because it's a national endeavor. But bringing in addition to that, philanthropic or non or grants or other types of funding, which is aligned to the overall development impact objective, even if it doesn't require a financial in the short term. So you might talk about or other grants, DCF, the GEF, bilaterals, others, multilaterals, others, technical assistance from development banks and so forth. These sources of funding, which are do not directly require a financial return associated with them, but then can then be blended with public finance, or wherever national governments are making a commitment on behalf of their taxpayer, as a way to scale up the bankability in the medium term of projects across society. So I think this is a particularly interesting area for work, and it's one that George and I are quite actively engaged on. And happy to share more about that with people on the webinar if they're interested. Thank you.
Thanks, Alex, for that. Well articulated in terms of how do we move forward. And truly, as I said, many African countries are engaging with this model of, CDF, and indeed, if we can be able to find out how can we be able to make it more robust and how can it be able to create more impact, I think that will be very useful. I think the last question that I want to put up, and I haven't heard a lot about that, when we talk about, the carbon market as an example, one of the biggest discussions and one of the biggest breakthrough will come when we can be able to use digital tools, and I'm curious in terms of, impact measurement, and what is the role of, for instance, digital tools, digitalization, and whether, within the study, whether there was anything that came about, and how we should be able to proceed with that. I mean, when you talk about, carbon credit, we are talking about digital monitoring, reporting, and verification. I think this is almost the same thing that you're talking about when it comes to, to impact, measurement. Then it's about monitoring, is about reporting, and it's also about verification. And how can we be able to use digital tools for that purpose? And maybe, George, you can comment whether this was something that was also put into the equation.
Yeah, absolutely. And it's something that is maybe the most exciting aspects of this story, I think, because I was slightly worried that we came out with a paper that was a bit negative. We were saying, like, here's another problem that you need to think about. But the digital tool side of it and innovation offers like a huge area of opportunity for making this easier for everyone. So I think in the report we published last year about the CDF, we talked quite a lot about digitalization for improving monitoring and evaluation of that fund. So we did even some calculations about how much it would cost to give everyone a mobile phone and internet access to go and like monitor projects and report that to a say like a online hosted, cloud hosted database. Like, I think governments in the past have spent so much money on very clunky online architectures, when actually there's now so many kind of easy cloud-based databases that exist where you can rapidly. So that's one side of it, just in terms of like easily being able to report and having like improved internet connectivity, which is, a lot better on the continent than a lot of people, particularly in I think there is an assumption for some reason that it's worse than it is in terms of connectivity. But the other side of it is that you can use things like artificial intelligence and more sophisticated remote surveillance tools for the investor to do a lot of the work themselves in terms of finding out what impacts are being generated. So if it's something like carbon or biodiversity, then you can do things like remote forest surveillance using Earth observation, or you can verify that data using say like drones within a specific forest, so you can understand the biodiversity or carbon related returns. And with the help of artificial intelligence and machine learning, there's kind of very, very rapid improvements in how quickly you can scale those things and what the costs are. So yeah, it's definitely an area that I'm quite excited about, and it's changing very quickly as well.
Thanks for that. And before I hand it over back to Solomon, because I think we are coming, to the end of this, because I can't see more questions. I just want, to reflect a little bit on what, we have gone through the last 90 minutes. And I think it's very clear to me, that indeed, if no data, no deal. Basically, what that means is that, we keep on widening the gap in terms of access to, to investments. And, looking at it positively, what is it we need to do? 4 takeaways that I'm listening from here. One is that we must be able to build the capacity. And this is the capacity of the investee companies for them to be able to appreciate how they can be able to measure, but more importantly, also how can they be able to manage impact. The second element that I'm hearing, is that we somehow need to come up with industry standards. Can we be able to have a way of defining that impact? Of course, conscious of the fact that, different cases, different countries, they have, different vulnerabilities, they have different dimensions. But in the context of that, can we be able to have some standardization, and which probably can be able to get rid of this impact washing? The third point that I hear, and a point that I really want to take very seriously is the role of policymakers. And how can we be able to use policymakers, to champion, this data, to champion impact, and for them, to think about how even to attract impact investors in some of the decisions that they are making. That way, then, for instance, the CDF would obviously be able to succeed. And the last one, is what we talked about, the role of data and innovation, digital and innovation when it comes, to bridging that gap about the data. And I think if these are areas that, we can be able to work on in whichever way, so that then, emerging markets, investee companies can be able to handle those things in a much better way, then that inequality probably in the long term will be eliminated. Because otherwise, if those pillars are not there, I think I still see the gap, extending. I really want to stop there, from my perspective. And I'll also give you a chance, to do, maybe a minute or two, just reflecting on the conversation here, but also more importantly is giving us a parting shot, and so that then we can be able to hand it over to Solomon. Should we start with you, Alex?
Thank you, Edward. I won't need to take a minute. It's just really to thank you and to Impact Capital Africa for hosting this webinar. I hope I hope it was helpful. I certainly thought that the questions that came through were really relevant and on point to the work that George has been leading here. So it's great to find it has some resonance. But at the end of the day, all of these reports are only there, to support a better outcome. So we're very happy to engage with those on this call. So you have our details. So if we can be helpful going forward, please do get in touch. Thank you.
Thank you, Alex. To you, George.
Thanks, Edward. Yeah, no, I just completely echo what Alex said. I think it's been, we've covered quite a lot of ground in terms of Zambia, Kenya, continent-wide impacts, different types of impact investors or data being used for different things. So, yeah, I think, there's a lot of things that maybe, of interest to specific people. So thanks very much for those who've engaged that conversation forward. I've put my my email address in the chat, and I'd be very, very happy to pick up on any of those specific themes if people are happy to.
Thank you, George, and back to you, Solomon.
Thank you so much, Dr. Edward. Thank you, Alex. Thank you, George, for the very insightful conversation that we just had here. And I know 90 minutes will never be enough for us to have a deeper engagement, but I think we have dissected quite a lot within that short period of time. And to our audience, thank you for connecting. Thank you for engaging. We'll be sharing this recording with you. And of course, if you have further questions or further needs for discussions, you can reach out directly to either George, Alex, or Edward. They'll share with me the contacts that I can give you as I send this recording. Also, the recording was also live on YouTube and LinkedIn, so you can check it out on Impact Africa Consulting channels. And happy to receive further feedback and get back to you. So for now, allow me to wish you a good morning, good afternoon, good evening from wherever you're connecting from. And that's it for now. Goodbye and connect to you soon. Bye.
Thank you all so much. Thank you.
Thank you. Thank you.
Thanks,
Bye.
everyone. Have a great
Bye.
afternoon.
Thank you.
Very good. Thank you so much. Thank you so much.